Good morning, ladies and gentlemen. We start the week's review by looking at TLT. If we enlarge the candle that we made for the week, we can see that we opened strong. We went nearly to the top of the Bollinger Bands and to these now downward sloping longer term moving averages, which are all bunched at between 123 and 125, let's call it. Failed miserably, just took out some stops, failed miserably and closed with a pretty ugly looking candle, nothing much. But we do now think that the 30-year is going to trade, or TLT itself and the 30-year as well, they're going to trade roughly around 120, give or take a couple of percent throughout the course of June. This will continue to turn the longer term moving averages and will give it impulse into the late summer, early October, November time to get a move going which will take it below this very important 115.26 level. We certainly think that from a portfolio perspective, any moves higher into the 123s and 124s are an excellent opportunity to lighten up on bond positions, simply because the stop is going to be so easy. The market closes above 125, you know that something is going on and you can rethink your strategy. So anything into the 123s and 124s, only a couple of percent away from there, is an excellent strategy to put on some shorts. That is naturally reflected in the pure yield chart for the 30-year that we can see we are now in this very important range that we said that would basically be 295 or just short of. We can put this level in here so you can see it all the next few weeks. We're talking about it won't go, just a moment. Here we are, 294.40 up to 319. This is basically a 20-25 basis point trading range that we will hold certainly for I would expect the whole of June and the whole of July. I can't see the market having much impulse to break either end of that trading range. On the 10-year, it's exactly as we wrote last week. Basically 270 up to 305 is your trading range. It is unlikely to be violated. We will trade mostly around this 286 area, which has been such a congestion area for such a long time. Again, we think that even on a daily basis we will build up enough of a momentum after the summer to break higher into a final push higher for the bonds to around 325, 350 in the 10-year, and that will be probably it for the year. As far as the Europeans are concerned, this is a chart of the five-year bubble in Germany. You can see how much the panic really moved things. But where did the market close? It closed within the very close to the Bollinger Band for the weeklies. This has now become a binary market, and let me explain that more fully. Italy either stays or leaves the euro. If Italy stays in the euro, the yield differentials and spreads between Italy and Germany will normalize. German yields will rise, Italian yields will fall. Or if the other thing happens, Italy leaves the euro, which is the unlikely option, German yields are going to go hugely negative. Simply because it's going to be a currency play. The fact that the euro will appreciate enormously against the US dollar. You will have the euro go towards 150, simply because a euro without the lira is a stronger euro. And you will have a massive movement of funds into the euro, which will force the certainly the short end and even the long end of the German curve deep into negative territory. So given that, the best way to play this is via options. Every time the 5-year moves deeply into territory outside of the Bollinger Band, you buy some puts and you look to hedge them again when it gets towards the Bollinger Band itself. It will not go very far from this Bollinger Band for the next several weeks, simply because the Italian government needs to be formed. They need to have a policy set out. They need to sit down with the European Union. They need to negotiate. It's almost it's World Cup time, and after that it's August. And during World Cup and August, nothing much happens in Europe, and therefore you can bet your bottom dollar that for the next 2 months there will be no resolution to the Italian crisis one way or another, and the market will tend to come back at least to this bottom Bollinger Band, if not to the middle of the Bollingers. So we're looking for around -6 basis points to around -25 basis points as being the effective true range. Are we going to have panics like we had last week? Well, possibly, depending on headlines. But you know full well that within 1 or 2 weeks the market will be at the bottom of the Bollinger Band again, and therefore that is your opportunity. Exactly the same picture in the Bund. You can see how much the market overshot on liquidation, fears, etc., etc. And where did it close? Right on the Bollinger Band. The same story that I gave you for the 5-year applies for the 10-year in spades. In fact, the 10-year is going to react less than the 5-year, simply because there's going to be less of a yield compression in the 10-year. In which case, I fully anticipate the true range of the Bund over the course of next month to be between 30 basis points and 55 basis points. That is going to be roughly your trading range, up and down according to the news that we get out of Italy and the EU. Now, just as DAX, just as you notice the way the market behaved between Italian bonds and German bonds. Every time Italian bonds collapsed, German bonds went up. The reverse is going to be true between the DAX and the stocks. When, if rather, Italy were to leave the EU, you would see the DAX collapse much the same way as the Swiss stock market collapsed when the peg went around 120. It would collapse certainly 15 to 20%, simply because you would have, the least I can see it is test this line around 8,000. So it's going to be a very, very pronounced move. You have to understand that a euro without the Italian currency in it also means a euro without Spain and without Portugal. However much they might want to stay in, the market is going to force them out, and they will realize that if Italy is 15 to 20% cheaper now because they have the lira again, the Spanish and the Portuguese and the Greeks and so on, they cannot possibly compete. It's a big, big question whether France can compete. My own personal opinion is that they can't. But what is going to happen is that you're going to have a separation of the euro into a northern euro and a southern euro. The northern euro will scream against the US dollar all the way up towards 150, even possibly higher. And what's going to happen to all the Italian stocks? Well, the Italian stocks are going to scream higher because the exporters are going to have suddenly probably a 20% advantage over their German rivals. So the spread between DAX and the stocks is going to come in by at least double-digit percentage points. So if you are ever bearish of anything to do with Europe and you think that Italy might leave the EU, you short the DAX. And if you are bullish and you think that everything is going to be just fine and dandy, the opposite, you buy stocks. It is going to be very advantageous over the course of the next few months, not now, but over the course of the next few months, say sometime in mid-August, to buy end of year puts in DAX, which are well away from the market, and also something like 9,000 puts or something like that, and also in the stock cash to buy calls struck around 3,600, because you will have a very interesting move at least to 4,000, if not higher, in the stocks if there is some kind of currency readjustment, and the market might give you those options for close to nothing. While we are at the stocks, I want to draw your attention to something quite interesting which is going on, and this is this very it's a worrying development insofar as these moving averages on the weeklies are all bunching together around the 3,500 to 3,520 level. That's all within less than a percentage point, and that probably presages some sort of heightened volatility at some stage. It is a possibility that stocks go and test this level again, 3,325. Note that level is going to be very important. If it gets down here, you want to be buying calls with both hands. But if now we fail here and we start pushing back up through 3,520, we will have a very quick move back up to 3,600. That is actually our favored direction of travel. But we're just telling you this level, 3,325, is a very important level which we've set an alert on, where we want to buy some calls, thinking that either now or later we certainly go and test this 3,665 level. Well, what of the US? Well, in the US there's only one game in town, and that is actually be long of tech, again short everything else. But let's analyze each index separately. Now, a lot of people are making a lot about this 2742 level that the market has failed to break for a couple of weeks. In fact, we haven't been above 2742 since early March. We don't think it's that significant. We think what the market is likely to do is bust through it, trade around 2750, 2760, and then probably give up and come all the way back down towards 2700, stopping everyone out. We certainly think that for a short-term trade, being long is better than being short. We think that 2742 will go probably very early on next week, and that we will trade at least 2755, 2765. We are just not that convinced that the market has the legs to go higher now. It will be very interesting if by the Thursday or Friday we have not backed off at all from the highs that we make early in the week. Then it's more likely than not that these Bollinger Bands will start widening out, and therefore we can have a sustained move. But at the moment we are skeptical that 2742 is all that important. Yes, we will bust through it. Yes, some people get very excited. Yes, some people will get very long. But we think that by the end of the week, they will have regretted buying into the 2750s, and we will be back down within below 2742, which will stop them all out, and then maybe we can actually go up. But we think the first break is unlikely to be the real one. Why do we think the first break is unlikely to be real? Well, simply because NQ and tech are now so overbought that they are above the top of the Bollinger Band. That is not a sign of weakness, that is a sign of strength, but it also is a sign that the market is likely to go sideways for at least 3 or 4 or 5 days, possibly even test below 7,000 to stop people out before it really makes a move. And that is why we can't see the market in ES being, or SPX being, all that wild to the upside. We know what the leader is. We have made very, very good money by being long NQ as opposed to the Dow or the SPX, and therefore we doubt that the market in SPX or ES has that much potential to the upside, simply because we think the potential to the upside is in NQ is fairly limited over the course of the next week. Certainly no higher than 7,100, and we could see it all the way back down to 6,975 over the course of the week before it makes another move higher. So we're not enamored with being long of any index in the States at the wrong level for next week. Volatility, that favored indicator of ours, tells us that we're going to have two-way trade. We think it's likely that we go and test these lows around 1240, possibly break them a bit, but we also think it's very likely, and I'll enlarge this for you, that we also fill this gap up towards 1640. It's going to be a two-way trade. Just as this gap is likely to be filled, so is this gap here likely to be filled. We're going to have two-way trade, and therefore that tells us that once we break higher, we are in terms of SPX around the 60-70 level, we are also likely to come back down and fill those gaps, and that is going to be quite exciting. We stop everyone out, and then possibly we can go again. So definite two-way trade being forecast by volatility, and therefore do not get enamored with long-term positions bought above 2742. 2742 we think is going to be quite meaningless over the course of the next couple of weeks. And finally we come to the dollar. The dollar index stopped exactly where it should have done, where this line is drawn, 95.07. That was about as high as it got to the tick, and back down it came. What is it likely to do? It is likely to come back and test at some stage this 0.382 retracement around 92.44. Before it makes up its mind, it either gets support from the 200-day moving average and the 50-day moving average and goes for another leg higher. But in the meantime, for the next couple of weeks, we think it ratchets lower towards 92.44. That having been said, it is likely that the dollar over the course of the next couple of weeks is going to be a bit of a tailwind to US equities, and that's one of the reasons why we think we'll definitely bust through the 2742 level. So we don't have a problem with trading from the long side in the US equities. We do have a problem with trading from the long side at bad levels, especially ones above the daily Bollinger Band. That has never worked, and it's unlikely to work in this context. The move that you're likely to see in the dollar is not going to be enough to propel SPX through 2800, whatever the Bollinger Band says. It's unlikely to happen, and therefore we would not recommend it. I wanted to show you this chart of the Dow Jones against the QQQ. Um, it basically speaks for itself. Ever since 2008, it has been one-way traffic with sharp retracements, but really it's been one-way traffic. So it's gone from 300 to 150. That means that the QQQs have really doubled in price relative to the Dow Jones, and the Dow Jones has done exceedingly well. It's gone from what, 6,000-7,000 up to 25,000 or 24,000 something. So we are talking about a market which has tripled, and this has gone up times 6. So if you now have an enlarged look at this area, you'll see that it's trending beautifully within a channel. The channel, it broke the previous all-time low sometime this week, and we were here when we were recommending putting it on because we could see the turn in the 50-day and the 200-day. It was still staying. We put on some position here, and we added some position there, and we added again last week. This market is basically going to the bottom here, and that has another 2.5% before the turn comes and we have the reaction back up when we will be putting it on. What is this saying? That is saying that NQ, in essence, because that is what the Qs are, will outperform to the upside the Dow by another couple of percentage points in the next couple of weeks. That to us indicates that there is actually going to be very, very little action in the Dow and in the SPX as a result. That is why we think it's unlikely that we are going to have net big moves in either of those indices. We could have volatility to the upside and volatility to the downside, but net over the course of the week, we are probably going to see very small moves. Certainly we think less than a percentage point on a weekly basis. So that is actually telling us that if we close 27.30, let's call it, on Friday, we are unlikely to close much above 27.60 next Friday, simply because the Qs aren't going to allow it. Therefore, yes, be still long of NQ, but mind your levels. This is now not a trending market. This is a readjusting market, and be careful what levels you get long of what index. One final quick look at SPY DBC, the commodities. This is just a nothing burger here. We've basically gone sideways for 2 or 3 months. We are now very nicely turning this 200-day moving average, and we think that any retracement back up towards these lines is going to be sold quite heavily. This is going to be the opportunity to put on some SPY DBC, simply because the stop loss can be so close above those lines. So the closer we get it to around 16, the better, and we can have a 1650 stop and we can forget all about it. This is going to be a wonderful opportunity, which we will tweet when we get there. And with that, we come to the biases for next week. As we said, 5s, 10s and 30s in a 30-point range. It might take all summer. We're quite prepared to keep on selling the vol. We did quite well last week. We shall continue doing so. As we explained, Bund and Bobble, while Italy is in focus, Germany will be bid. It's unrealistic to expect a huge move higher in yields at the moment. But what is not unrealistic to do is to buy options every time they go through the Bollinger Bands, the weekly Bollinger Bands, as we showed you in the video. And as we said, Germany is now binary. Either, Italy gets out or it doesn't. If it doesn't, and there is a final deal, which we think is the most likely outcome, German yields are going to be much, much higher come the winter. SPX, as we said, this is what we wrote last week. No oxygen above 2740. More likely to have a false break of 2700. It happened. Did it come to 2660 for us to buy it? No. We bought some small, but never mind. Now looking for how it behaves at 2760. We think it gets to 2760, but we think it rejects at 2760 and comes back through 2740 and stops everyone out, and then probably goes back up to 2760, 70. We're looking for a basic ratchet between 2700 and 2760, 70, 80 as the weeks go by. That is the kind of ratchet that we are looking for in the market. NQ is still going to be the one that outperforms every time it drops. It should be added to. We will test the all-time highs, and also we are going to tweet to you when the chart that we showed you gets to the bottom, the SPYs against the Dow against the Qs. We will tell you when that gets to the bottom of that trend channel, and then you'll be able to take off the position at a profit and wait for the bounce back and reinstate, because that is a trend which keeps on which will just keep on going for the foreseeable future. NQ outperforming just about everything. As we said, European equities now are going to be very tricky, simply because it's as binary as the yields, and therefore we will tweet you some option ideas on those. DX, we also said what is likely to happen. We have gone through both sides. We spiked both sides of the ending diagonal. Now we're likely to go back and test the 0.382. As we said in the video, that is what we expect, and that should no longer be a headwind. This is from last week. This should no longer be a headwind for US equities, so we'll remove that. Certainly we think that US equities are going to be better bid than European equities, simply because the risk in European equities is so much larger for the next few weeks and months, and there will be rotation out of Europe and into the US for sure. Thank you very much indeed, and tweet you on Monday.